Welcome back to another episode of Multifamily AB 360. And today's our guest is Zihao Wang from Motiva Holdings. Welcome, Zihao.
Thank you so much for having me, Rama.
How are you doing, Zihao?
Good. It's been a busy week underwriting deals and also traveling to conferences, but staying busy is always good.
Awesome. A little bit about Zihao. Zihao Wang is the founder and CEO of Motiva Holdings, a vertically integrated real estate private equity firm that specializes in lower middle market multifamily investments across the US. At MH, Zihao manages 0.5 billion worth of assets across 34 projects and leads the acquisition, capital markets, and development processes. Zihao attended MIT and is actively involved in the Urban Land Institute, National Multifamily Housing Council, NMHC, and other real estate associations. So with that, Zihao, you want to add anything to your background?
I guess I'll just take a walk through how I got to where I am today and the journey of everything. So I started in real estate through the family. My parents started back in 2008, just buying properties locally where I live in Pasadena, California. And they've always wanted me to join the family to take over the real estate, learn everything within it. So in 2016, I joined the family venture as a property manager, mainly managing our own family's assets. And that was when I learned the days in and days out of property management and everything that has to go with operations in real estate. So did that for 2 years before moving on to the acquisitions and capital market side of things. From there, I've been more on the asset management role and acquisitions and capital market specialist role at the firm. So now I'm more at a higher level, buying the right deals, putting together the capital stack, as well as overseeing my colleagues' work in terms of operations.
Awesome. Thank you very much. So right now, your company is like 34 projects managing, right? So share me some key milestones or some key challenges or opportunities around those projects.
Yeah, so I guess milestones from when I first started to now would be my first exit and my very own first deal. Those were small deals, typically under $5 million. Those were big projects for me specifically because I was the sole lead on those. So without the guidance or much help of my parents, it was more me making the decisions, me putting the capital stack together. And so those were definitely big milestones, getting the first deal as well as exiting the first deal, knowing that kind of what I learn and what I'm doing is correct from a profit and returns perspective. And opportunities and challenges right now, I would say, is mainly on the deal flow side for the challenges. The market is pretty slow in terms of transactions because partially because of where the debt is, but also because of elections and some uncertainty with where our political landscape is headed. And so because of that, people are more sitting on the sidelines and maybe waiting until 2025 before they actually want to do anything. And right now, there's this disconnect between some sellers having to sell while buyers are more sitting there and seeing they want a clear picture of the economy as well as the political landscape before they do anything. So I would say right now, you can get good deals at low prices if you're willing to hop on the train. But then at the same time, sellers' expectations are still pretty high. And so you don't want to overpay as a buyer simply because you want to get into a deal. And so this disconnect causes deal flow to slow down quite a bit. So that's like the main challenge I'm facing. And then opportunity, there's always great opportunity in every single market. You just have to find the right asset that provides the value add and has the meat on the bone and enough upside for you to capture through better operations and renovations.
Awesome. Thank you very much. So and in the previous question, you answered like your priority is finding right opportunities, right deals, right? So what was changed from 2016 to 2022 and like 2022 to now? So how you were underwriting deals?
Yeah, so the biggest change really happened between 2021 and 2022. That was when interest rates was from the very, very bottom to the very, very top. And so that taught many people a lot of lessons in terms of what kind of debt they should be getting. Back in 2021, they were able to get bridge debt basically at the same cost of permanent financing. And you get more proceed from bridge debt because you don't have a DSCR constraint. And so many people chose bridge debt which turned out to be not the best decision because rates went up really quickly and bridge debt soon turned out to be possibly the worst decisions that they've made in probably the last 5 years. And so it was a lot of lessons learned. And luckily for us, we did more refinancing and dispositions during 2021 and 2022 rather than acquisitions. So we were actually still able to do really well in terms of our portfolio. We saw what's happening in the economic landscape, right? We saw how people were hurt because of the rate increases. And so in terms of acquisitions, we're much more conservative in terms of the debt side of things because we know how much debt can kill a deal now. So we're typically always doing 65% leverage and then off of a 125 or 130 DSCR. And off of permanent financing, where today's rates are maybe 5.5 to 6%, you're pretty safe and pretty in the money. And in terms of acquisitions, we're being much, much safer because rates are still elevated and we don't see rent growth being where it was during COVID. And so from an operations perspective, there's only so much we can do. And so we're trying to do our best to make a safe real estate investment that is recession resilient.
Got it. Thank you. So what markets you're focusing? Did you change any market selection also?
Yes, previously we were exposed. Currently, we're still exposed to three markets: California, Florida, North Carolina. We're looking into our fourth market, Texas, right now. It's challenging in Texas because so there's a big wave of supply and demand is it's hindered, right? It's there's a lot of concessions, a lot of vacancies there. But then if you think about it, it was also the most active state in 2022 time. So a lot of people made really bad decisions when it comes to acquisitions in that specific state. So what we're specifically targeting right now are those distressed deals or deals that, have good fundamentals in terms of an asset, but were just financed incorrectly. And we're trying to pick these deals off to add into our portfolio. So we're doing more of a recap and repositioning play where, we don't have to do much to the asset itself, but we can play better with the financing side of things and then make money 3 to 5 years down the road.
Got it. You mentioned good fundamentals, right? Assets, you're targeting assets with good fundamentals. Can you expand on good fundamentals? Like,
Yeah, so we typically play in the value add space. And so we see a lot of different types of assets, right? If you talk about fundamentals, I'm talking about like the bare bones of the asset, right? How's the plumbing? How's the electrical, right? How's the mechanical systems? Or how's the roof? How's the exterior? How are those like fundamentals that are actually related to the asset? The best fundamentals are the class A newly constructed buildings, right? They were just built with the most up-to-date code with probably some energy and solar stuff there. So those are the best. But those are also where your returns are lowest because your price to buy that asset is really high. And so we play in kind of a class B to C kind of in those kind of properties, whereas typically between the 1970s to 1990s deals. And so those are typically, they can be 50-year-old buildings. And for those buildings, it's really important to inspect the fundamentals of the building to see whether the plumbing is copper, to see whether the plumbing has broken before, to see what kind of electrical systems are there, when the roof was changed. And because all of these fundamentals determine how much CapEx you have to underwrite and have to put into the deal. The less CapEx, obviously, the less money you spend and the better the deal is. So we're looking for deals with good fundamentals where we don't have to spend so much money to change the so-called major systems of the property, but can still have enough upside to make a good return.
got it. Yeah. Thank you. Thank you for explaining that. So from capitalizing point of view, what kind of strategies you guys are implementing to raise capital?
So we really raise from other family offices or fund to fund managers. We're a family office ourselves, so we typically put a big equity check into the deal as well. And we like to see partners putting at least $500,000 into our deals. We don't really like mass raising from the retail investors with 50K or 100K checks because our team isn't like sophisticated to do that. Most of our team members are operational people, less so investor relations people. We just haven't built that branch of our team out. And so we raise from our connections within the family office world, as well as fund of fund managers, as well as private equity groups. We can write those bigger checks and go shoulder to shoulder with us. So for us, a deal wouldn't typically have more than 5 investors.
Got it. So what kind of typical returns you're offering to your investors?
So we always target the high teens returns. So kind of 18 plus returns is what we're targeting. What we're targeting. We try to under promise and over deliver all the time. So we've hit deals where we had over 30% returns. We've also hit deals over 20% returns. And so we try to always over deliver and under promise. And we reflect that in our underwriting.
Got it. Yeah. Thank you very much. Key components of your vertical integrated it adds value to overall process.
Yeah, so we're vertically integrated in terms simply means that we don't outsource to a Greystar or a Avalon Bay. We found it to be more working with since 2016 and that are on my payroll rather than somebody else's payroll. Things get done quicker and things get done with a more cost efficient strategy managing the inefficiencies of real estate operations. And so we really like the fact that we're vertically integrated, just gets things done faster and easier.
Got it. Got it. Sure. Um, on the current market, there are like macro and micro economic factors impacting overall income, expenses, property values, right? How exactly you guys are exactly what kind of strategies you guys are implementing to improve revenue or cutting expenses, improve overall net operating income?
Yeah, operations has been really tough in the past few years. And that's due to many things. Like one is the rising of uncontrollables like insurance. With climate change and everything, you saw more natural disasters. And so the insurance companies had to increase their policies. Additionally, with rates increasing, insurance companies were squeezed in terms of the premiums that they were able to deliver to their investors. And so they had to increase their policies on that front as well. And in some states, property taxes also increased. And so these like uncontrollable expenses really impacts NOI because there's very little that you can do in order to mitigate these expenses. At the same time, we also had controllable expenses increasing, right? You had renovation costs going up because labor was up and supply was short. The cost of materials and the supply for those materials were short. And so those cost a lot more. And then also labor, payroll, everything just increased. And so expenses were just going through the roof for not just multifamily, but almost every asset class, hotels, right? You also see any kind of single family homes also increasing because of that. And so at the same time, we have NOI decreasing because the the expenses were rising and then net income was decreasing because with expense rising and debt service rising, you have two fronts that you have to defend against. So NOI has been really difficult to drive and net income has been even more difficult to drive. And so from our side, we've been really focused on cost cutting and budget saving. We were exploring the best ways to renovate a unit in order to get the highest rental premiums, right? So we could no longer spend 15K on a unit anymore. So we had to dial that down to maybe K. And we have to figure out what exactly are the best ways to spend this in order to get whatever premium we can get. And so that typically resulted in changing bathrooms, changing flooring, changing kitchen, and maybe if there was budget, adding a washer and dryer into the unit. And so we were being much more conservative in cost saving mode than increasing our cost and trying to get the highest premium. We're thinking about what's the most assured rental premium that we can get. And that was the strategy we've been implementing on the operation side.
Got it. So efficient with return on investment, right? So in some markets, last couple of years, huge supply, right? Supply versus demand component also impacting overall returns. So the markets like Florida or North Carolina, a lot of supply came in. So what kind of mitigate strategy you guys implemented for existing project, especially? So overall,
It goes down to cost saving. Like the supply that you mentioned really hits our top line, right? When a new waves of supply, like 400 units come online within a mile from your property, then that property does its lease up. They're going to offer concessions. So from the tenant's perspective, you have a vintage property that's charging you X amount of rent. And then a new build property that with concessions is charging you maybe X plus $50, right? Because of that small delta, it was much easier for the tenant to just leave the 1980s vintage and move to the new construction. And that's happened not just in Florida and North Carolina, but almost all of the major red state market that we saw with great economic and population growth, like Texas being a big hit from that. And from a top line perspective, we were really hit in terms of rents, right? We didn't see the rent growth that we wanted to. And so because of that, we had to, just focus even more on cost cuttings because there's really nothing we can do on the revenue side that can really outcompete other people, right? It's like when a 400 unit building comes by right next to your building, there's nothing you can do about that, right? So they're going to give their concessions and we're going to have to give our concessions. And that's the risk of multifamily, right? So our revenue was hit. And so because of that, we had to focus on expense cutting. That was the only thing that we could really control within our hands. And so that's what we focused on. We focused on different ways where we can cut costs, right? That included lowering our staff, reducing the amount of staff on our properties, right? Instead of having multiple on-site managers and repairs people, we had to lower that amount in order to boost our NOI and not go underwater on a lot of our properties.
Yeah, got it. So you started as property management side and to move towards other aspects of like multifamily, like acquisition or leading other teams and managing teams, right? So how exactly over a time, how exactly you evolved as a leader and what challenges you faced? How did you overcome?
Yeah. The biggest lesson or the biggest thing that I had to do as, I guess, the overseer is to have tough conversations. When things are great, everybody's very happy. Everybody really wants to see each other. Conversations go really well because it's always positive. When things are not going so great, people don't want to see you. People don't really want to report what happened this week because it wasn't that great. And so we had to have a lot of tough conversations, how we should go from here. And so these are tough conversations that people like me, people in my position, has to our colleagues. Additionally, we even have to motivate our colleagues to tell them that there is hope at the end of the tunnel as leaders in order to number one, not freak everybody out, and also make sure that we're still trending towards the right direction in terms of progress. And so definitely, even though things were rough, and then had to have a lot of tough conversations.
Awesome. Yeah, good points. Thank you. So as a leader, what drives you to continue expanding and improving your portfolio?
Yeah, we have big aspirations and big goals at the firm. We're hoping to with big shops in order to scale our portfolio and do bigger deals, a track record that people can trust. We know that we have to continue building our portfolio, doing more deals, rolling up from deals. And so because of these kind of joint goals within the firm and joint aspirations, we're continuing working really hard every day, we're pretty much 7 days a week, all the members of the firm, and then trying to scale the portfolio, do our best and scale the company.
Got it. 7 days a week means so most of your team are like from your family and kind of stuff, or how exactly you bring resources?
Yeah, we have a lot of resources within the family for sure. So that's definitely helped. That helped in terms of getting me into real estate at the very beginning, at a very young age, as well as continue scaling. But at the same time, we built great relationships with other people as well, right? So we know some other family offices who have joint invested with us, and we've joint invested with them as well. And then also, on the lending side, it's great to have a great balance sheet that can support deals so from all those fronts, the family is definitely really key as a resource to help scale the company.
Got it. So would you share any of your best experience so far?
Yeah, I would say the best experiences has been probably our most recent acquisition. We did a really good $20 million acquisition in Downey, California recently. I wouldn't say it's like the best experience, but it's probably the best experience I've had in the last 6 months with how slow the market was. But yeah, we were able to get an off-market deal from a long-term owner. We got it at a 5.5 cap, which in California is really high, and also 5.5 cap with upside, right? So there was about a $300 to $500 loss to lease on those deals, on that deal specifically. And so we're able to go from 5.5 cap and push it to a low 7 to mid 7 return on cost and then sell back at a 5.5 cap. So no cap rate compression, just pure getting loss to lease. And because we're just capturing loss to lease, we don't need to depend on rent growth either. So very safe business plan with a proven strategy that we've done multiple times in our local market. And then also a big enough deal where we get everybody excited for it. So that's definitely a great experience I've had in the last 6 months. Didn't have too much success in terms of acquisitions in the last 6 months, only did probably this deal and two others much smaller deals, under $5 million deals. And so, very excited for that one and also pretty happy that I was able to secure that one.
Awesome. So would you also share any challenging experience?
Yeah, it's mainly on the acquisition side. Like I said, market is slow right now. Transaction volume is down. It's very hard to finance in terms of debt and equity. And so I'm underwriting like 20 deals a week, but most of those, like almost all of those deals don't pencil either because of the lack of upside or because they're selling at a price that just doesn't justify the value of the property. And I'm underwriting a lot of deals. I'm seeing a lot of deals. I'm talking with a lot of brokers as well as other owner operators, other private equity firms. And it just seems we're seeing a lot of deals, but very few of them are actually meeting price expectation on the buyer side. And very few of them are getting transacted. And so I'm stuck in a position where I have the capital to do a lot of deals, and it's the deals that are not coming my way. And I'm hoping that a better political landscape and a better economic landscape in the next year can really help boost transaction volume and sellers can lower their expectations to meet the market and we can do a little bit more deals on our side.
Got it. So what's your take on multifamily investing next 12 to 24 months, from interest rate point of view and also other aspects?
Yes, I really like multifamily as an asset class. So from a long-term perspective, really like the affordability story in the United States, as well as the supply and demand story in the United States. So both of these are big drivers of why multifamily is such a strong asset class. And specifically for the next 12 to 18 months, then we'll have to see where the economic landscape and political landscape shakes out because that drives a lot of movement within the market, right? I'm a long-term believer in multifamily, but if you put a year time frame on this, we'd have to see where we are in terms of interest rates, where the sellers are expectation wise, where capital is, and all of those factors that feed into how much transaction volume is going to come. At one point, we were at 80% below the peak of the market. So I don't think it can get much worse than that. So I do believe there's light at the end of the tunnel. Things are going to get moving. Transactions are going to get done. Financing is going to become easier. So that upward trend is going to be. And I'm not too sure exactly on where transaction volumes or prices are going to be in the next 12 months. I do think it's going to get better though.
Got it. Thank you. So let's shift towards personal side. So what habits that are helping you to be successful?
So I think knowledge is power. I really like reading. I really like learning about new things. So I read a lot of books. I read a lot of articles. I also listen to a lot of podcasts. These are super informational things that tells us where we are in the economic cycle, where we are in the multifamily cycle, experiences from past operators, experiences from lenders, experiences of brokers. So all of this knowledge is key things that I believe have made me successful in my career and love reading articles, listening to podcasts, and making sure that I learn something new every day.
Awesome. So any personal learnings that played major role in your success?
Sorry, any pure.
Any personal learning that played major role in your success?
Yeah, I would say I listen to podcasts every single day. I also read different kinds of articles every single day. And so for sure, like reading is very key to getting knowledge and being successful.
Any books that impacted you more?
Yeah, from a mentality perspective, Rich Dad Poor Dad by Robert Kiyosaki is a great book. They talk a lot about what kind of mindset you should be as an investor. A lot of books like The Warren Buffett's Way is also a great book. Talks to you about like how you should be seeing stuff as an investor, right? It's how managing people is different also. So yeah, but the most famous books is probably where you should start with. And then as you start that, you know what books you like and what books you don't like. And then you can diverge from there.
Yeah, good tip. So how are you giving back to community?
So I'm a big tennis player. I started playing tennis when I was 6 years old. Played it in college as well. Love tennis, and my community is really big on tennis as well. So I try my best to give back to the community by volunteering at our tennis camps and playing with children in elementary and middle school because sports is a great mind reliever, first of all. But at the same time, it teaches people discipline, perseverance. And these are key things that I feel like was really impactful for me and things that I learned from a young age, right? So I try to not when I play with younger kids, I don't just play for the sake of playing tennis, but also try to teach them kind of the lessons that I learned along the way, then try to instill to them the mentality and the personality that shapes who I am. And so I love spending time at my local tennis center and tennis camps playing with the younger generation.
Yeah, awesome. Yeah, sports are always like good for me from mental perspective and also fitness, health perspective, right? Awesome. And how can listeners can connect with you?
So I'm pretty active on LinkedIn. You can find me there. And then also you can find me on my website, www.motivaholdings.com.
Awesome. And thank you very much, Zihao. Thank you.
Thank you so much, Rama.
Awesome.